This video will change how you think about investing forever. Bold claim, I know, but bear with me and you'll see why. But first, did you know that only 4% of all stocks in the US are responsible for virtually all of the stock market's gains, and that more than half of individual stocks actually lose money in the long run? These shocking findings came from one of the most fascinating studies in modern finance. Professor Hendrik Bessemmbinder's research back in 2017 completely changed how we understand stock market returns. Today, I'm going to explain why this matters for your portfolio. We'll cover why index funds have consistently been outperforming active managed funds, how these funds actually work, and whether the current concentration in tech stocks should worry you. By the end, you'll understand why some of the world's smartest investors recommend a strategy that sounds almost too simple to be true. In 2017, a finance professor at Arizona State University named Hendrik Bessembinder published a study that sent shockwaves through the investment world. What started as an academic paper about skewness or asymmetry of returns quickly captured the global attention when people realized its implications. Bessembinder analysed the performance of about 26,000 US stocks from 1926 through to 2016, and his results were genuinely shocking. He discovered that 4 out of every 7 stocks in the US have underperformed cash, specifically 1-month Treasury bills, since 2026. For those that don't know what Treasury bills are, they are short-term government debt securities considered to be highly liquid and often treated as cash equivalents due to their ease of conversion into cash and minimal risk of value fluctuation. Even more incredibly, just 4% of all companies accounted for the wealth gains for the entire stock market during that period. Out of 26,000 companies, only 1,092, a mere 4% of the total, generated all of the net shareholder wealth above Treasury bills. The other 96% of companies collectively contributed nothing to market outperformance. The average cumulative return since 1926 was an astounding 22,840. But the median stock, meaning the middle performer when all stocks are ranked, actually lost 7.41%. That's an enormous difference between the average and median returns, showing just how skewed stock market returns actually are. When Bessembinder expanded his research globally, the results were even more extreme. Looking at over 64,000 companies across 43 countries, he found that only 2.4% of global listed companies accounted for all of the market's performance above the short-term government securities. Of these companies, just a top 159 firms, a mere 0.25% of all companies, accounted for 50% of all wealth creation. These findings showcase what economists call positive skew in the market. Most individual stocks perform worse than the average, while a small number of massive winners pull the average up. Historically, so-called growth stocks have underperformed in the long run because of human inclination for optimism, which leads to overpaying for the lottery ticket-like stocks. Bessembinder also found that companies typically remain publicly listed for only 11.6 years on average, with just 31 stocks remaining listed for the full 98-year period of his study. This high turnover makes picking long-term winners even more difficult. Among the biggest winners, Altria was the best performing stock over the entire period, with an annual return of 16.3%, from 1926 through to 2023. More recently, Nvidia has had the highest annualized return of any stock with at least 20 years worth of data at 33.4% per year. This winner-takes-all dynamic isn't new to markets. In the early 1800s, bank stocks represented about 3/4 of the total stock market value. Railroad stocks dominated in the early 1900s, and the internet-related stocks took over in the late 1900s. Today, as you well know, it's primarily tech stocks leading this charge. Given the extreme difficulty of identifying which handful of stocks will be tomorrow's winners, many investors have returned to index funds as a solution. But what exactly are these funds and how do they work? An index tracker fund is essentially a cheap, simple investment fund that mimics the performance of the stock market. Instead of trying to pick individual winners, index funds simply buy all or most of the stock in a specific market index like the FTSE 100 or the S&P 500. As Jack Bogle, the founder of Vanguard and pioneer of index investing, famously put it,
we all know the metaphor of finding a needle in a haystack. It means forget it, it's not worth trying. Own the haystack means own the entire US stock market or the entire world stock market. And don't do anything once you get the haystack. No more looking for needles.
Index funds typically use one of two main approaches to track their target index. First is full replication. This involves buying all of the stocks in an index at their correct weighting. For example, a FTSE 100 index fund would buy shares in all 100 companies in the FTSE 100. Number two is stratified sampling or partial replication. With large indices containing hundreds or thousands of stocks, buying every single component might be impractical. In these cases, the fund buys a representative sample of stocks designed to closely track the index's performance. For major indices with both large cap and small cap stocks, many funds use a blended approach. Full replication for the liquid large cap stocks and sampling for the less liquid small caps. The evidence for index investing has become increasingly compelling. According to recent data, US passive index funds in 2024 outperformed nearly 2/3 of actively managed funds. This isn't just a one-year anomaly, it's consistent with past results. When results are compounded over 20 years, about 90% of active funds produce returns inferior to low-cost index funds and index ETFs. This pattern holds true across developed markets, emerging markets, and even bond funds. Even small caps, which had a good year in 2024, have struggled over the long term, with only 11% outperforming their benchmark over the past 2 decades. Total market index funds offer investors a straightforward way to gain broad exposure to the entire equity market with one single investment. These funds track comprehensive market indices like the CRSP US Total Market Index or the Wilshire 5000, providing diversification across thousands of stocks spanning various sectors and company sizes. One of the key advantages of index funds is their low cost. Since they don't require teams of analysts researching individual companies, they typically have minimal expense ratios compared to actively managed funds. This cost advantage compounds over time, allowing investors to keep more of their returns. A small fee compounded can end up costing a very significant amount of money. I'm talking tens, if not hundreds of thousands of pounds or dollars over the years. The challenge facing active managers is clear. When we look at Bessembinder's data, if only 4% of all stocks drive all the market's excess returns, and more than half of stocks actually underperform, stock picking becomes an extremely difficult game. For active managers to outperform legally, and the key word there is legally, they need to either outweigh the tiny percentage of companies that will become massive winners, or avoid the majority of stocks that will underperform. Both tasks require extraordinary skill or extraordinary luck. And the data shows us that even when managers succeed in one period, they rarely maintain that outperformance consistently. The uncomfortable truth is that the investment industry has demonstrated it's generally poor at identifying future stock market stars. For every fund manager who chances upon a winner that makes their career, hundreds of others fail to beat the market. Despite the strong case for index investing, Some active managers argue that this time is different. Let's examine their main arguments. First, some claim that the popularity of passive investing has created an unhealthy concentration in the market, making indexing increasingly risky. Now, it is true that market concentration does exist. Currently, a few technology stocks known as the Magnificent Seven have around 1/3 weight in the S&P 500 index, and they were responsible for more than half of the market's returns in 2024. However, this concentration isn't unusual historically, and given Bessembender's findings that only a small percentage of stocks drive most gains, owning the entire market through index funds ensures you always have these crucial performers in your portfolio. A second argument suggests that index investors pour money into the stock market without regard for fundamentals, which compromises the market's ability to reflect information accurately. Some argue that this creates mispricing that active managers can exploit. But there are also logical reasons to reject this claim. Even if 99% of investors use index funds, the remaining 1% would likely be sufficient to ensure that new information gets reflected into stock market prices. And historically, evidence doesn't support the idea that market bubbles create easier opportunities for active managers. During the post-internet bubble years, between 65 to 75% of active managers still underperformed the market. So, what does this mean for your investing strategy going forward? First, it suggests that broad diversification is crucial, since we can't know in advance which handful of stocks will drive future returns. Owning the entire market through index funds gives us the best chance of capturing these vital performers. Second, it highlights the importance of low cost. With most active funds underperforming, paying the high fees for active managers typically leads to lower net returns. Index funds offer a cost-effective way to access market returns. In the UK, for example, investors have access to numerous index tracker options, including funds tracking the FTSE 100, the FTSE 250, global indices, and more. For global exposure, options like the Legal & General Global Equity Index provide a one-stop shop for worldwide diversification. It's worth noting that while index funds aim to track their benchmark indices, they do not guarantee returns. The aim is to track the performance of a given index, whether it's going up or down. So unfortunately, you might still get back less than you invested. However, over a long period, broad market indices have historically delivered positive returns. Bessembender's research has fundamentally changed how we understand stock market returns. The extreme concentration of wealth creation in a tiny percentage of stocks has made a compelling case for index investing. Most stocks do badly over the very long run, but the biggest gainers more than make up for the losses. Since we can't reliably identify these future winners in advance, owning the entire market through low-cost index funds remains the most sensible strategy for most investors. The evidence continues to grow even more compelling over time. For most people, buying the entire haystack still makes more sense than searching for needles within it. Index investing typically results in low fee, low transaction costs, and tax efficiency. Sometimes the simplest investment approach is also the most effective. To help smooth peaks and troughs, it's also recommended by many professionals to dollar cost average. This is where you invest the same amount of money through regular intervals. This ensures you buy more when the price is low and less when the price is high, therefore protecting your downside and stopping you buying too much when the price is too high. If you found this information valuable, please hit that like button and subscribe for more investing content. Please also leave your thoughts in the comment section and I'll see you on the next video. Ta-ra.